Hi, everyone, and welcome to our panel on navigating the treacherous fintech M&A space. As Adam said, my name is Dario DiMartino. I'm a US-based M&A partner, and I'm one of the co-heads of our global fintech and blockchain practice. For those of you who don't know us, we're a law firm. We've got about 500 people in the US, but globally we have 5,000 people, and so we can do M&A transactions seamlessly across jurisdictions, and we cover virtually 99% of the world's GDP. With that, I'm very excited to be introducing and speaking with today's panelists. To my right, Emily Mann, who's an investor at Redpoint Ventures. Welcome, Emily.
Thank you. I'm excited to be here.
Thank you. And Christina Rust, who's head of strategic investment initiatives at Treacherous Ventures, and also one of the head of Empire Angels. Welcome, Christina.
Thank you.
So before we get started, I always like to know a little bit about the audience so that we can sort of tailor our remarks accordingly. So just by raise of hands, who spends 100% of their time in M&A?
Judging by the number of people in this room, I'm thinking that is there M&A happening right now?
That's a good point. All right, who's on the business side of things versus legal side of things? Let's do business first. All right, most on the business side. So I will withhold my legal and regulatory remarks unless you guys have questions.
I'd love to hear those. I'd be very curious.
Happy to do that. But with that, why don't we start with sharing a little bit more about yourselves with the audience. Emily, why don't you go first?
Absolutely. So I'll start with myself as well as Redpoint. So Redpoint is a Bay Area venture firm. We've been around since the late 90s or so and investing across a bunch of different areas, of which fintech is one. That's where I spend the vast majority of my time. And we've backed companies including Stripe, Nubank, Ramp, as well as a couple of insurtechs like Next Insurance and Vouch. And so, yeah, I'll turn it over maybe to Christina as well.
Sure. Treacherous Ventures is a stage-agnostic fund backed by Treacherous Financial, the 6th or 7th largest bank in the U.S., depending on the day. But we are a strategic investor, so we are looking to deepen and broaden partnerships with companies that we make investments in. We also invest to learn, so teams, products, markets, we just want to stay close to and find ways to use our platform to help them to build. And then also investing for social impact. Treacherous is a purpose-driven bank to inspire and build better lives and communities, so we really try to find opportunities to further financial access and equity in the communities that we're a part of, help reach sustainability goals for ourselves and our clients, pack more diverse funders and founders. And so we are, our team is between Charlotte and New York City, where Treacherous is based. And I joined the bank about 18 months ago and moved back to the US from London, where I had been head of European investments for another corporate venture fund.
That's impressive. Thank you, Christina and Emily. And it's also not lost on me that we have two women at the forefront of the fintech industry, an industry that, yes, thank you.
Thank you.
An industry that, historically has not been tremendously diverse. So I'm really excited to have you both on the stage. So with that, let's talk a little bit about trends and drivers that you see in fintech M&A this year. Whoever wants to go first.
Yeah, I can start. So it's bleak, I think, is the bottom line of it, right? I looked up some data before this panel, and if you look at FT Partners' Q1 report, fintech M&A volume was at $9 billion. While that sounds like a big number, just to put that in context, that is the lowest it has been since Q2 2020. So the midst of the pandemic, when everyone was kind of freaking out and trying to figure out what was going on. And then if you look again, back historically in time, the only other time before that when it was that low was in 2013, right? So we're in a rout right now in terms of transactions happening, and there's a couple of things that are, I think, driving that on the back end. First and foremost, from an investor perspective, there's a lot of these companies that are startups that have raised a lot of capital in the glut of 2021 and extending into early 2022, right? And so I think that the number of folks that are still heads down, building, trying to make their business work and not yet coming to the realization of like, oh shoot, like this is not gonna work out, we should explore strategic alternatives, it's just not, those conversations aren't happening yet. And then on the acquirer side, we work with a lot of scaled companies who would be potential acquirers of some of these smaller businesses, right? And what they're seeing is for a lot of the smaller type companies, because the talent market has now loosened up, there's not as much appetite to do the acqui-hire type acquisition anymore. And at the same time, when it comes to strategic expansion opportunities or adding new business lines, many are still in the process of shoring up their own balance sheets and figuring out their own cash burn and conservation, and are not yet in the mode of being progressive around M&A.
Yeah, I think the only thing I'd add is that for strategic acquirers, a lot of them have strong balance sheets. They could be more acquisitive and out hunting for deals, but their own investors are not looking for growth's sake right now. Public market investors want to see even large companies streamlining, looking at their costs, focusing on growth in existing products and markets. And so when your own investors are not saying that that's what they're looking for from you, then you're very unlikely to go out in the market and try to find those opportunities. We're not in that speculative phase right now of the cycle. We're starting anew. On the private equity side, there's been a ton of private equity capital raised over the last several years that does need to be put to work, but their cost of capital has gone up on the debt side. And so while there are definitely some attractive opportunities in the market, look at some of the fintechs and even enterprise SaaS companies that have IPO'd over the last 5 years, a lot of those are trading below their IPO prices. So there is an arbitrage there that would be attractive in theory for private equity. But they are really only going to be interested in opportunities where they can bring in that operating playbook and really add value so that when timing is right, they can, bring it back to market. And so there's a lot of opportunities out there and fewer of them ultimately that I think are going to be looked at this moment in time.
Yeah, I would agree with that. I think there's been a much lower number of transactions this year, and that's also sort of caused by the fact that there aren't that many quality targets out there. That said, when there is a good quality, a good target out in the market, I've noticed that there's a lot of competition among both strategics and private equity. And the private equity folks are starting to act like the strategics, right? And some of the strategics are trying to sort of emulate the private equity in terms of offering better terms or rep and warranty insurance, but there's a lot of competition out there for good targets. But I would agree with your statement, Emily, that in terms of volume, it's been pretty low. Yes.
I think we're sort of in this waiting period too. I don't know if Redpoint is seeing something similar, but we're seeing a lot of atypical rounds right now. It's extensions, it's secondaries, it's investment alongside partnership. Yep. You're seeing a ton of activity around that, which is really sort of allowing companies to continue on until some sort of clear signal suggests what the ultimate end game could be for some of them.
That's right, and it's also been that some of the previous rounds that some of these emerging companies have raised were at a very high valuation. Yes. Right, and given what's happening in the market, it's hard to match or not to cause a downturn with all that causes. So moving on, what are some of the strategic sort of elements of a fintech investment or target that you look for, and what can a target company do to prepare for an investment or an exit?
I think one thing that's really important to think about initially is understanding where your product or technology fits in with the strategic roadmap of potential acquirers. I think especially, again, where we are in this new cycle, you're not going to see a lot of opportunistic M&A getting done on the strategic side. It really needs to fit into the broader picture. And so really understanding how you can, sell yourself as a long-term partner, whether that ends in a transaction or not, I think is really important. And with that, being able to articulate how you, sit on top of existing systems, play nicely with existing infrastructure, I think is important, particularly in, regulated industries like financial services. How are you the pipes or the plumbing or the bridges that can quickly come in and help to expand to new markets or accelerate capabilities in a valuable way, I think is really key. Also making sure that you identify the right advocates within an institution. I think this is true on the investment side as well, but I'm often sitting down with entrepreneurs who are saying, okay, this is the 12 different people I've talked to. Can you explain to me what exactly they do within the organization, who has authority to make decisions? That's all, whether you want to call it politics, organizational structure, that you should try to understand and make sure that, within, the potential, acquirers you may be interested in building relationships with, who are the people who can advocate for you in the meetings that you're not in, and stick with you for the long term. Because again, I think certainly on the strategic investment side and with M&A, people change jobs. You could lose that person that you've spent years building a relationship with. You want to make sure that you have a good collection of people who can advocate for you. And then lastly, I would say, consider alternative structures. I mean, everyone thinks of, I IPO or I have an M&A, but are there other ways to build, long-term strategic value with some of these partners, through a JV or a consortium structure? There's lots of different ways, and lawyers are great at thinking creatively around this stuff, hopefully as our investors. But I think, thinking expansively about ways that you can work together to build value is really helpful.
That's great. Yeah, I think from an investor perspective, one sort of pretty damaging mentality that we see in early stage startups a lot is that like M&A or thinking about a potential acquisition tends to be almost taboo, right, in the early days. Like it feels like selling out. Everyone, of course, is shooting for that IPO, that, NASDAQ listing. And so they tend to be heads down, build, sell, compete, and then at some point come to the realization like, oh shoot, this probably isn't going to work out as a standalone business and we're going to need to look at strategic options. But at that point, if you're starting to try and pick up a conversation there or start building relationships with potential acquirers at that point, like it's too late, right? And so something as investors we oftentimes will counsel our companies to do is like have those conversations early on, and they don't have to be M&A focused or, exit focused. Just start to get to know these people and build that trust, have them bought into your vision, what you're building, your strategic value, and then over time that becomes a much more natural conversation, and you won't find yourself in the situation of needing to, become a distressed asset on the market.
Yeah, I couldn't agree more. I've worked with a lot of, I typically represent buyers, strategic buyers, and it's really a shame to see a transaction die because a target company is not prepared for that exit, right? You send a due diligence request list and you realize that the company is completely disorganized, right? And it takes months to answer even the most basic questions. So my advice to those who are building a company is, yes, to Emily's point, you don't have to focus on an exit or an IPO or a joint venture or other strategic investment, but you got to have your ducks in a row, right? You've got to have your documents cleaned up and ready to be diligenced by a potential investor or a buyer. I see a lot of interesting questions coming in. So let's see if we can answer some of them. There's one that asks, do you see companies pivoting internationally to IPO outside of the US? Any thoughts on that? I've seen in my practice that some companies now are trying to sort of re-domiciliate outside of the United States because, depending on what you do in fintech is a very broad term, right? What do you do? Payments, you do crypto, what do you do? AI, there's so much. But there are some areas in the US where the regulatory framework is not clear, and a lot of companies are saying, you know what, we don't want to spend millions of dollars in lawyers trying to talk to the regulators. Let's get outside of the US, and when we're bigger, maybe we can come back. Do you see that in your portfolio?
I can't say that we have. I do understand that, the bar to go public in the US is much higher than it is in some other countries, like Australia, for example. But we haven't yet seen any portfolio companies or companies we've talked to look to, domicile elsewhere in order to pursue an exit.
Yeah, and generally speaking, that only makes sense if you have a significant book of business in another country or geography. But the U.S. is always going to have the most liquidity in the market, and so that's from a secondary perspective is what's attractive for investors.
Yeah, I agree with that. So, do you expect to see increased investment and/or consolidation in the AI sector, given the hype around generative AI?
Oh gosh, we could do an entire panel
Agree.
on this topic. AI is hot right now. It's probably what myself and very much of our team is spending the vast majority of our time on these days. It's hard to say for now, just given the fact that the space seems to change every 5 minutes or so. Right now, there seems to be a lot of early noise in terms of companies starting up or testing out new models, and I think that over time you will definitely see consolidation happening in the space, and there'll be a few winners emerge.
Yeah, I mean, this reminds me of, 6 or 7 years ago, I suppose, when, everyone was hyped on VR and thought that VR was like the next coming of the Messiah. And then we saw, then the metaverse was, the thing that everyone thought was, we were all going to be living in, in 2023. So everything goes through these hype cycles. I think that's where we are with generative AI right now. I think more broadly, we're starting to see adoption of machine learning and some kinds of AI within regulated industries, but it's going to be quite a while before financial services is really adopting, any of these, more frontiers technologies in a meaningful way.
That said, though, I feel like AI has been around in financial services for a long time, right? I think generative AI has just made this much more consumer-facing in the ability to interact with it. But for years, banks and other folks have been using AI and ML technologies in and around claim servicing or underwriting or other things. It just wasn't as public in the same way that it is now.
Totally agree. So we talked about, trends and how to get ready for an exit. Now let's talk about the time when you found a target, you signed and closed the deal. Let's talk about integration, right? The success of an M&A transaction is really dependent on integration. So what are some of the best practices and strategies that you would recommend in terms of integration from a commercial, IT, tech, and perhaps customer experience perspectives?
Yeah, I think, even before a deal is signed, I think it's really important to understand the values of the two companies that are coming together, and that's more than the posters on the wall that talk about everyone values integrity and things like that. A lot of corporate values sound very similar on paper, but the question I think comes how are those actually implemented and utilized in practice? How are decisions made? What are the leadership styles of the people on each side? Do those mesh well together? You need to really spend time and determine if you have a good value match in practice and not just on paper, because I think that can break down the value of those relationships pretty quickly post-integration. I also think it's really important to have a dedicated PMI, post-merger integration team within the acquirer that is solely focused on making sure that that company is well integrated and has the appropriate eyes on it to help with the transition, as opposed to maybe someone assigned within the business, the acquiring business, to just sort of look after it as an additional activity. I also think that communication is really important, both internal and external. There's so much uncertainty on both sides when deals are announced. And so making sure that everyone understands what's going on, what the timeline looks like, what are the synergies, really over communicating, I think is really, really important in those scenarios. To the extent possible, it's always great to acquire whole teams. Because that gives anyone coming into the new company an immediate support system as they adjust and adapt to sort of the new situation. I think it's a lot harder when you're sort of cherry picking and just bringing in a handful of people at a time. So I think those are all things that we've seen be really successful.
I would totally agree, and I think one of the most important aspects that you mentioned that I kind of want to stress is stop operating in silos. I kind of feel like when it comes to integration, IT only speak to IT, business only speak to business, legal only speak to business. We all have to talk to each other, right? Otherwise, integration will not be successful, and that needs to happen, to your point, before you even sign a deal, let alone close.
Yeah, 100%. I was going to say the exact same thing, except you put it much more eloquently than I ever would have. I guess my point of view is if you're not talking about integration, alignment, making sure everyone is financially and otherwise incentivized to make the merger work before the docs are even signed, you're probably in trouble.
Agreed. So we're almost out of time. We have another couple questions, but before we get to the question, we can always answer them after the panel if you guys have time and interest. Let's quickly conclude with some remarks about predictions about the fintech M&A landscape for the rest of the year.
Yeah, so from an investor perspective, I think what we really saw in the last 2-3 years, an explosion of the number of fintech companies that were out there, right? I think any category or problem that existed, there tended to be 5, 10, sometimes even more players that emerged around the same time to address the issue. That, at the end of the day, is not sustainable because these folks are burning through VC money to try and compete on price, and ultimately, very few of them can build sustainable businesses. And so I think that it's inevitable that you're going to start to see consolidation towards winners in every sort of major category within fintech. And so I think right now we're in a uniquely low point where everyone's kind of still trying to figure out what's going on. And there's, as you mentioned before, this sort of asset pricing dislocation in the market where people don't really know what things are worth. But eventually that's going to reach a new equilibrium, and we're going to start to see this activity pick up again.
Yeah, I think that's absolutely right. The only thing I would add is, I think we're seeing a real openness and eagerness on the part of companies to have these strategic discussions with potential just partners on a more consistent and programmatic basis, which is great. And whether that ends in ultimately in an M&A transaction, who knows? But one of the things I find really exciting in the fintech space is that there's a lot of collaboration amongst investors, amongst partners, amongst potential acquirers, and so this sort of relationship building that we can do as an ecosystem will, I think, help the ultimate winners to find the right place for their opportunities, if and when the market opens appropriately.
I will read you both, and just to add my thoughts, I really hope that this year we're going to get more clarity from the U.S. regulators. What I've noticed in my practice is that a lot of businesses are going outside of the U.S. or buying non-U.S. companies, and I really don't want to happen what happened years ago with the semiconductors industry, where a lot of U.S. companies went overseas, and now we're paying extra to bring them back. So this is an invite to whoever is in government and works with regulators to please give us more clarity. With that, this is the end of our panel. This has been incredibly energizing discussion. So thanks very much, Emily and Christina, and please join me in thanking them as well.